let's just quickly recap what we heard from the FOMC in their last meeting in July. So at the July rates meeting then, the Federal Reserve opted to maintain policy at current levels in line with broad market expectations. We saw no updating of the FOMC forecasts and no press conference following the meeting. So the only means of communication that we had at that point was the meeting and the statement accompanying the decision. So in the statement then, the Fed struck a positive tone, noting that near-term economic risks had diminished, with economic activity expanding at a moderate pace and labor market having strengthened. Inflation, however, was noted as remaining low and likely to remain so in the near term, though expected to rise to the Fed's 2% target in the medium term as transitory effects fade. In terms of the domestic economy then, household spending was noted to be growing strongly, though business fixed investment remained soft. Referring to the rate path, the Fed noted that they still see only gradual increases in the federal funds rate as being appropriate, though the actual rate path will depend on incoming data. One further bullish development then was seen in the voting split, which changed from unanimously in favor of keeping rates on hold to 9-1 in favor of rates on hold, with Kansas City Fed President George voting in favor of a hike. So in all, the meeting passed as expected, with the Fed citing some small improvement in the outlook, downplaying Brexit risks and confirming their data-dependent stance. So the US dollar spiked initially in response to the statement, though fell lower shortly after, with no reference to the potential timing of any rate move. Markets were left split between a September and a December rate move. We then, of course, had the July FOMC meeting minutes. However, these failed to provide any further indication of the likely timing of the next rate hike, as members remained divided over whether to raise interest rates soon. The minutes stated that near-term risks have diminished, leaving some scope for a hike this year if economic data continue to point to a resilient US economy. On labour market conditions then, most committee members saw relatively low risk that a further gradual strengthening of the labour market would generate an unwanted increase in inflationary pressures, but they still preferred to defer another increase until they were more confident that inflation was moving closer to 2% on a sustained basis. Some Fed officials raised concerns on Brexit as it creates uncertainty about medium to longer run outlook for foreign economies that could affect financial conditions in the United States. So again, not really any more color provided on the July FOMC statement. Since that statement, however, we've had plenty of key US data, which has been particularly market moving, again, giving the Fed's reaffirmation of their data-dependent stance. Now, data over the period has broadly underperformed expectations and highlighted weakening economic conditions.